Hey everyone, welcome back to Corporate Decoder, the place where we dive into company filings and uncover the real story behind the numbers. And this time it looks like we've got Artelo Biosciences gearing up for a funding boost, and honestly it feels like a bit of a race against time. Today we're dissecting a Form 8K from Artelo Biosciences filed on July 18, 2025. Artelo Biosciences is a company in the biotech space, and specifically, they are announcing a pretty significant move to raise capital through an at-the-market offering. So what does this actually mean for the company and for investors? Let's decode it. This report is all about a new agreement Artelo has signed to sell its stock directly to the public over time, essentially a way to bring in cash as needed. They are calling it an at-the-market offering agreement, and this is with a firm called R.F. Lafferty & Co. Inc. acting as the manager or the sales agent. The goal is to raise up to $6.5 million by selling shares of their common stock. Now, $6.5 million might sound like a lot, but in the biotech world where research and development can be incredibly expensive, it's often just enough to keep the lights on and fund ongoing projects. Think of it like a flexible way to get cash. Instead of having to do one big fundraising event, it lets them sell small amounts of stock gradually as market conditions are good or as they need the money without disrupting the stock price too much. The shares will be sold on the Nasdaq stock market, which is a major exchange, meaning the company is publicly traded and accessible to a wide range of investors. This also means they've met certain listing requirements, which is a positive sign of legitimacy. This agreement allows them to sell shares whenever they decide to, and it lays out the terms. They can sell on Nasdaq or other trading markets, and the sales agent R.F. Lafferty & Co. will handle the transactions. The company can even tell the agent to stop selling if the stock price dips below a certain point they deem acceptable, and they can pause the whole offering if needed. This part here is important because it means they are complying with all the SEC rules and regulations for this type of offering, which is good for transparency. They also mention that they will pay the sales agent 2% commission on sales plus cover certain expenses. So for every dollar they raise, a small percentage goes to the agent for their service. This gives Artelo some control over the pricing of their shares during this campaign. They don't want to be forced to sell their stock at a price that they feel undervalues the company. The offering will continue until they either sell all the shares they plan to or until they decide to end the agreement. Both Artelo and the sales agent can terminate the agreement with just 5 days' notice. This shows flexibility and gives both parties an exit strategy if things don't go as planned. It's interesting to note that they had already registered a much larger amount of stock, previously up to $75 million for a similar at-the-market offering. This current deal is just for $6.5 million, which might indicate they are being more cautious now or perhaps have specific, more immediate funding needs. This filing also includes legal opinions from Fenimore Craig PC, basically confirming that the shares they plan to sell are legally issued. This is standard procedure for these types of offerings, and it's a necessary step to ensure everything is above board. So the core of this document is this agreement to raise up to $6.5 million. It's a way for Artelo Biosciences to gain access to capital efficiently. In simple terms, they are selling a piece of the company on the stock market gradually to fund their operations and development. The CEO, Gregory D. Gorgas, has signed off on this report, indicating management is fully behind this strategy. This is a common tool for companies, especially those in volatile sectors like biotech, to manage their cash flow and fund growth initiatives without the immediate pressure of a large traditional offering. Now let's think about what this means for investors and for Artelo's future. This move signals that the company needs cash to continue its operations, which is normal for a biotech firm. However, it also means that existing shareholders might see their ownership percentage diluted somewhat as new shares are issued. Dilution means your slice of the pie gets smaller when more slices are created. The success of this offering will depend heavily on the market's perception of Artelo Biosciences' future prospects, the strength of their underlying technology or drug pipeline, and the overall market sentiment towards biotech stocks. If investors are confident in the company's science and its potential to bring products to market, this offering could be very successful in providing them with the necessary funds to advance their research. On the flip side, if the company's pipeline faces setbacks or if the stock price falters, this ATM offering might not raise the full $6.5 million or it could put downward pressure on the stock price as more shares become available. It's a delicate balancing act. Artelo Biosciences as a company is focused on developing treatments for cancer and other diseases. Companies like this live and die by their research, and their ability to secure funding to push those discoveries through extremely rigorous and expensive clinical trials. This at-the-market offering is a lifeline, a way to keep that critical research going. Warren Buffett famously looks for companies with strong fundamentals, a clear competitive advantage, and a management team that acts in the best interest of shareholders. For a biotech company like Artelo, the fundamental is the science, the potential of its product candidates. The competitive advantage is its unique approach or technology, and the management's job is to steward the company through the extremely challenging process of drug development, while maintaining financial stability. This ATM offering shows a management team that is actively managing its finances to ensure it has the resources to keep moving forward. It's not necessarily a sign of weakness, but rather a proactive step to secure necessary funding. The key question for investors will be, what exactly is Artelo Biosciences doing with this money? And what are the milestones they expect to hit with it? Looking at it from a high level, Artelo is essentially saying we need more fuel to get to our next destination, and we're using this flexible method to get it. It's a pragmatic approach to funding in a capital intensive industry. Now for my take, Artelo Biosciences is navigating the tough terrain of biotech funding. This ATM offering is a smart tool for managing cash flow. It allows them to raise money as needed without the immediate heavy lifting of a traditional public offering. However, investors should always remember that these offerings can dilute existing ownership. The success hinges on their research pipeline and the market's belief in their scientific advancements. It's a constant bet on future innovation. The company faces significant risks inherent to drug development, including trial failures and regulatory hurdles, but also has the potential for substantial rewards if their treatments prove successful. What's your take on Artelo Biosciences' strategy with this ATM offering? Do you see it as a positive step for funding innovation or a sign of potential financial pressure? Let us know your thoughts in the comments below. If you found this breakdown valuable, please give this video a thumbs up and subscribe to Corporate Decoder for more in-depth analysis of financial filings. Also, don't forget to join our Discord community linked in the description below to keep the conversation going. Thanks for watching, and we'll see you in the next one.